The new financial year FY20 rings in brave new regulations for India Inc. The way these companies, large and small, borrow and the way they manage their cash has to change drastically. Hello and welcome to our special show, Indianomics. I'm Latha Venkatesh. Before we go across to our excellent panel of guests, let me take you through the key changes that the banking system now needs to adhere to. In fact, all of India Inc. needs to adhere to at the start of the new financial year, FY20. Well, first up, let me tell you, these are rules which the Basel Committee, the International Committee, has been pondering for a long time. Actually, from way back in 1991, Basel was worried that if a bank is overexposed to one borrower or group of borrowers and that borrower fails, then the bank fails and the entire banking system can be taken down on a domino effect. So this is it's a hoary past from 1991. Finally, it was only in April 2014 that the Basel Committee drew up the rules of how much a bank can take exposure to a group so that the risks are diversified. Now, RBI itself also went through these large exposure rules and came out with them on December 2016. They said they gave the banks more than 2 years. Why only the banks? India Inc. more than 2 years to adhere to them. And on April 1st, 2019, these rules on exposure to large groups become effective. What are the rules? First, that a bank can take exposure to any company only to the extent of 20% of its Tier 1 capital. Mind you, capital, just to explain for a minute, for those who are not familiar with capital, if a bank has 10 rupees of capital, it raises about 90 rupees of deposits. So the limit is only 20% of its capital. If it has 100 rupees of capital plus deposits, then 2 rupees is the limit to which it can take exposure to one company. So that's a fairly conservative limit. And when it comes to groups, banks can take, for a company itself, with board permission, it can take another 5%. So a maximum of 25% of its capital is the exposure limit. When it comes to large conglomerates or groups, for the group as a whole, banks are allowed to take exposure up to 25% of their capital. So one group can get only about 2.5 rupees of loans if the total money with the bank is 100 rupees. It's 2.5%. Approximately, I'm not getting into risk-weighted assets. Okay, now Reserve Bank is also going to consider group of connected companies. Now, I'll come to that group of connected companies in just a minute. What does Reserve Bank mean by a group of connected companies? Basically, if one company is totally interdependent on another company, in terms of its entire sales or its entire purchases, then that would be considered an interconnected company. Okay, so that's very important to note. These may not be from the same group, but if, for instance, say Maruti is entirely serviced by one company and that company sinks or swims with Maruti, if Maruti fails, then that company fails. So that will also come within that 25% limit. Okay, the next thing that you have to note is, what does RBI mean by connected companies? Connected companies will be, basically companies of the same conglomerate. So, for instance, Tata Sons has the ability to influence all the Tata companies. Sometimes there are cross holdings. Tata Power may be having a holding in some other Tata company. So interconnected companies will be considered connected companies. Obviously, they could be connected by voting rights, or they could have an influence on the board. One company could be deciding the management as well as the board of another company. So all those would be called connected companies. We also spoke about dependent companies. Now, all these are the kind of exposures that will fall within the Reserve Bank limits. RBI has also defined what kind of exposures. It is not just loans that a bank gives to a company. Off-balance sheet exposures will also be counted. Okay, basically all these, if any bank were to breach the exposure limit, it has to report to RBI immediately, and within 30 days, that breach has to be corrected. That is, it has to bring down the exposure. That's an important rule. Also, what kind of exposures we are talking about? It includes both on-balance sheet loans given as well as off-balance sheet exposures. That is, if it is a guarantee or a letter of credit and such other exposures, which are called off-balance sheet exposures. So all these are covered in the current set of rules for large exposures. I just want to add one more rule that comes into effect today, that is April 1st, 2019. And that is the rules that govern cash credit. This is totally different from large exposures. This cash credit rules is going to affect everyone, from the smallest SME to the largest corporate borrower. In India, companies have something called a cash credit limit with every bank or with their key bank. These are largely for working capital, salaries, raw material, inventory management. You know, when you get the money, you put it back in that account, and when you need the money for a short-term purpose, you withdraw. Now, Reserve Bank says that you can't have such a limit entirely, because the cash management of the company falls on the banks. And therefore, at least 40% of what you withdraw from your cash credit limit will be construed as a loan. So you have to take it as a loan for a minimum of 7 days or for any length of period, but you can't have this flexible arrangement whereby the company's cash management problems are palmed off to the banks. The intention is to raise this 40% to 60% sometime in the future. Well, those are the two major rules that have kicked in as of April 1, 2019. How does it change the terrain for banks on the one hand and companies on the other? We have two representatives of either side to explain to us. VG Kannan, the Chief Executive of Indian Banks Association, and Sunil Srivastava, former Deputy Managing Director of State Bank of India, join us to explain the bankers' point of view. Sanjay Jain, the CFO of Future Group, and Praveen Sood, the former CFO of HCC, are also with us. Gentlemen, thank you very much for joining me. Well, first up, Mr. Kannan, let me start with you. I think there are still some unexplained areas you told us earlier. What are the doubts you have? I think the doubts were with respect to derivatives exposures.
Yeah. Good evening, Latha. Regarding the derivatives exposure, hello?
Please go ahead.
Can you hear me? Different way. Yeah, regarding the derivative exposure, just now we have got a letter from Reserve Bank of India, and this very clearly says non-centrally cleared derivatives exposure will be outside the purview of exposure limits till 1st April 2020. Okay. However, banks must compute this exposure separately and report to the Department of Banking Regulation on a quarterly basis. So this is a major relief which has come to the banks who have been dealing with across the counter and derivatives, because the PFE exposure used to be pretty high for many of the derivatives transactions, and then would have ensured that it will be breached, and which would have resulted in many transactions not taking place.
Okay. All right. Well, let me come now to the people who are faced with the new music, the CFOs. Sanjay Jain, what are your first impressions? Do you think large companies which have infrastructure projects to execute, could have a problem if they are already at 25% with their bankers?
I think firstly, these steps are in a way good for the long-term financial health of the markets. But somewhere, whether we talk of infra companies or any other large corporates, when these measures are implemented, they are assuming that the markets are mature, markets are deep and wide, and there are enough other sources of capital, be it equity, be it debt market, bond market, or the corporate India has been accessing the FPI NCD route as well, or the money through NBFCs. I think if these sources of alternate capital are robust enough, are deep enough, then I think we at corporate end can absorb the impact of all these changes. But I guess last couple of years have seen equity market going to the peak, then kind of cooling off a bit. The last few months have been turbulent with respect to NBFC's market or so. So in these transition phase, I think there is some tough job for VCFOs to do for some time to come. So to that extent, infra companies, any large companies would have to do some homework, to kind of rejig the sources through which they could raise capital.
Okay. Well, that straight away takes the question to Praveen Sood, who has been managing the finances of an infrastructure company until recently. Praveen Sood, is this a big problem for only the big groups, the top 20 groups, or will there be a problem even for smaller groups, these large exposure limits?
These could be a problem with even the companies who are getting, exposed to the larger limits. Because infra company, once they start getting the order, the entire exposure ramp up very quickly because you need to give guarantees and everything, and you realize that you are just ramping up this entire things very, very fast. So I think even for the upcoming companies in the infra sector who are growing quite fast, which is very natural because the way the infra spend is happening in this country, I think very soon few more companies, some upcoming companies will face the music, and it would be very difficult for them to go to different banks and set the limits and all those things. And it could be also lead to other problem because once you got the contract and then if you have to rush with the bankers to get the bank guarantee limit because you have crossed exposure with some banker, I think rightly said that we are not mature enough so far financially as a country to impose all these restrictions at this point of time.
Well, at the moment, we don't see such a clutch of infrastructure companies with orders. CapEx is at a low key. But Sunil Srivastava, do you agree with what Sanjay Jain and Praveen Sood are saying? I was under the impression it's only the top 20 groups or some large companies with large loans which will have a problem. Do you think, as Praveen says, even a smaller infrastructure company, if it has run its limit with its traditional bankers, could be faced with a problem?
Yeah, actually, if you see, we have opened up the demand side, but the supply side is something which remains unattended. And it's if you read the circular, they have not excluded the Navratnas or the infrastructure sector. But definitely, if you look at the overall tier 1 capital for most of the banks, apart from the 5 major banks and the 4 or 5 private sector banks, most of them will be breaching their tier 1 capital ratios when they finance to any of these major groups. So to that extent, there could be a reshuffling of the portfolio between the weaker banks and the larger banks. And then if viewed in the context of who's running the infrastructure, who's bidding for the infrastructure, is mostly these 5 or 10 large groups which are actually at that leading the effort. And there, if alternate capital is not provided or alternate supply side problems are not tended to, we will run into a problem going forward.
Okay.
So I would agree with both Sanjay and Praveen. Yes, definitely there would be issues there.
Okay.
While on the face of it, yes, aligning risk to pricing, getting Basel recommendations in line here is fine. But I think simultaneously the institution setup also needs to be built up.
Yeah, I agree. I mean, I don't see how they could have excluded infra. In fact, the whole problem was because of overexposure to some groups which were exposed to infrastructure. And that's why we had this huge bad loan problem. So I guess they could not have excluded infra. But Sunil, do you think oil companies will have a problem? They are perennially in need of large amounts of working capital. Do you see a problem in that sector?
Yeah, it's not only the oil companies, but if you look at the group approach, I'm sure the major oil companies have several subsidiaries, and if you look at all the connected companies and the subsidiaries, I'm sure their whole total requirement will sooner or later, the total capital, tier 1 capital in this country would be in the region of 8 to 9 lakh crores. So 25% of that is around 2.5 lakh crores.
Okay.
So if you look at the requirement going forward, there would be a problem for them also to raise money, especially the lower rated among these, good Navratnas.
Okay. Mr. Kannan, you wanted to comment on that? Do you think that immediately that could be an unexpected problem, oil companies? Or fertilizer for that matter?
Yes, I think what Sunil did mention that, all these interconnected companies, because in addition to being in the same field, they're also connected at the top. The controlling interest is mainly with the government. We have also sought a clarification from RBA. We had expected FAQs from RBA on this, and I'm still hopeful that that will give some exemption to such company. But as of date, no such exemption, and they will also be impacted by this.
Okay, but Mr. Kannan, to address Praveen Sood's problem, that you could get a large order and you're already reached your limit with your traditional banker, and to start ab initio with a new bank could be difficult. I mean, these are days with Acrylic, where a huge database of information is already available to all banks about all borrowers. Will it be so difficult for a fresh exposure in a new bank for a company like Praveen Sood is mentioning, Mr. Kannan?
And new bank will take its own time. What he is trying to say is, as and when an application is given, it doesn't mean that they're going to get it sanctioned immediately. But having said that, the culture in India is many of this bank guarantees, etc., even after completion of the project, the same is not extinguished and returned. And therefore, the limits continue to remain used, and therefore the need for additional limits. If the culture completely changes, I think this also should not be a major problem. It's not a question of only additional limits, it's a question of how the completed projects also, the bank guarantees are returned back so that the limits get vacated. And over a period of time,
whose
that will
fault
also
is
get
it?
resolved.
Is it the corporates that have to ask, or is it the bankers' problem, Mr. Kannan?
No, it's not the corporate, it's the system, especially whenever you issue a bank guarantee. Okay. Very often the bank guarantees remain with the what you call the agency which is providing asking for the contract. Okay. And that is something which is plaguing the system. Even when arbitration cases are there, it's an issue. Okay. But having said that, I just wanted to also tell you, you also mentioned only about the loan delivery mechanism. That's one more item, what is called the market mechanism, which I think indirectly someone mentioned. Yes. That also kicks in with an additional further reduction in the limits from 25,000 to 15,000 crores today. Okay.
Oh, okay. Well, actually, I wanted to come to the market mechanism also because, as Sanjay Jain and Praveen Sood pointed out, the bond market as an alternative source of financing is not yet developed. For that matter, even equity markets for certain categories of investors is not entirely available every time. To discuss these alternative sources of capital, we have to take a break and be back. Solutions to how companies can raise money if the banks are not able to. All those questions after this break.